Welcome back to the IB Investor channel. In this video, we'll cover some KPIs for most of the Swedish real estate companies on the listed market. We'll have a look at the interest coverage ratio, the loan to value, price to property income, dividend yield, and occupancy ratio. Now this video is going to be a little bit different. As you can see on the left side, we have a massive amount of companies here, so we're not going to dig into details. And I can just mention as a disclaimer that some of these companies have not reported their Q3 earnings yet. So, some of these numbers here on the left side could even be worse than they are currently. So this is just, a snapshot on how the situation looks like right now. Anyways, now for the interest coverage ratio for these companies, and the interest coverage ratio is a debt and profitability ratio used to determine how easily a company can pay interest on its outstanding debt. So the lower here, basically the worse, and the higher the better. And on this list here, I basically sorted them on lowest to highest. So here we have Bonusudden here, or Bonäsudden at 1.5 times, which is very low. And then we have Sagex here with the highest at 6.5. So we can see a massive difference here in terms of how good the coverage is here for the interest ratio here. So we have a lot of companies here with below 2, and I think that is quite alarming. I mean, even sitting at 2+ up to maybe 4 or 5 in this type of market environment is kind of dangerous. But certainly anything below 2, I would say, is quite alarming. So, investors looking into these companies, Brinova down to Bonäsudden, should be, aware that the interest coverage ratio for these companies are very, very low, and they should be careful when investing in these companies, because if they can't pay the interest, they will default on their loans, and that could mean, mass selling for, prices that the company is probably not under normal market conditions willing to sell for. So, be very careful, at least here when looking at these companies here below 2. But even between 2 and 3, we have a lot of companies here. So from Samhällsbyggnadsbolaget here up to Corem, so these companies in between here are quite, it's not super dangerous, but I would certainly, be a little bit careful when looking to invest in these companies as well, right now at least. Now for the loan to value ratio, basically measures the loan amount against the value of the real estate. However, the value of the real estate is often up to management of the companies to decide. So in some cases it can be pretty skewed, I think, and we've seen some managers who have been criticized that that they had put a overvaluation of the real estate compared to what the market dictates right now. And they get some help from the editors or auditors that audit their buildings and the value of those. Some do it every year, some do it every quarter, some do it every half year or something like this. But oftentimes many of these companies, they do audit most, if not all, of their companies at least once a year. But at least just bear in mind that the value side of this KPI can be subjective, in my opinion. It's down to the management here what they want to sign off on. But anyways, it's sorted here from highest loan to value to the lowest. So here on this end we have K2A at almost 64% loan to value, and here the lowest is Huvudstaden here at 20.6%. So quite a difference here in terms of loan to value ratio here. And I can just mention that it's bad to be up here if you have a very low interest coverage ratio. And just as a reminder, this company, if you remember on the last page here, we could see that K2A had a interest coverage ratio of only 1.6 times. So this looks pretty alarming that they both have pretty low interest coverage ratio and very high loan to value ratio here. So this company, it looks pretty alarming right now for this company. And I remember Brinova also being one of the lower interest coverage ratio companies here. So it looks pretty alarming, at least for these two companies. But if you're sitting in this end, and you also have a pretty high interest coverage ratio, then it's probably not an issue for you. You're probably gonna survive without any issues as it is right now, because financing may not be as difficult as it is when you're having to refinance these amounts of loans to value ratios. So oftentimes the creditors and often the banks, they will look at this number as well and see, well, if the loans are so much higher compared to the own value of the real estate, then oftentimes they will probably give a higher interest rate to these companies, and they have to pay higher interest rates as a consequence, worst case. Again, just as a reminder, just remember that this is not a deep dive into each specific company, but rather just a quick snapshot here. So now for the price to profit income here, and we can see that Bonus, Udden, and K2A were the companies with the lowest interest coverage ratio in the first page here, and they're also then, it seems, the highest price here to profit income. So quite expensive companies, I would say, when just looking at this. We also have Heba here at 41 times, and we also have the Samhällsbyggnadsbolaget here at 1.1 time, which is the lowest here. So big difference here in price to profit income, how the market is valuing these companies in terms of share price here. But we can also see some middle ground here where perhaps it's a good idea to pay somewhere between maybe 9 to 12 or something like this right now for these type of companies, since it looks like most of the companies are at those levels. But do please bear in mind that just because a company such as Trianon has 11.5 times price through profit income, it doesn't mean that it's cheap necessarily, because we do have to remember both the LTV, as we mentioned on the previous page here, and also the interest coverage ratio, as we mentioned on the first page here. So there are many other KPIs that you have to weigh as well when you're looking at evaluating a company or measuring a company here. So this is just another KPI and just a quick snapshot on how the valuations looks like here for price to profit income. Now, it is quite interesting to see here, because we have the dividend yield, to see that some companies here are actually still paying a dividend despite of the market conditions here. So this could mean that management has confidence in their business, but it could also mean that the board has overconfidence in their balance sheets. But at least here we have Fast Partner D shares at the highest here. So the D shares in Sweden is very similar to a preferred share, I would say. So that's why they oftentimes have a little bit higher yields, but going from 9.8% to some companies here having 0. So I think it's been more, the board here for these companies have probably been a little bit more responsible here to not pay a dividend. However, we do know that SBB, they just halted their dividends, so they're probably gonna have to pay it at the end of the year or something like this. But right now it looks like they're not paying it, but the board has declared, as far as I'm aware, that they should pay a dividend. So we're going to see what's going to happen there. But there are still some companies with a dividend yield here. So some companies will pay dividend here, which is very interesting. And I think Trianon was also one of those companies that, scored pretty low in many of these figures that we saw previously, which is not good. And they're still paying a dividend here. So, some struggles here for some companies. It's good to see at least here that Bonus, Udden is not paying a dividend, nor is Brinova, which were some of the companies. I think K2A was actually a company that probably shouldn't have paid a dividend when looking at hindsight here. But quite interesting to see that at least some companies are paying dividends. And, if you believe that the companies will survive, I mean, these dividend yields are pretty high for some of these companies. Like, for example, here we have Cibus at 1.1% or 8.1%, sorry. Kallebäck here at 7.2%, Nyfosa at 6.9%. So quite high dividend yields, probably even comparing it to historical measures here. But you have to remember that there are a lot of risks with all of the real estate companies right now in Sweden. So don't buy into this company just because of the yields, because that's just, very risky right now. Here we can see how the company rates in terms of occupancy rate from the highest to lowest. So here we can see that K2A actually has a pretty high occupancy rate, which is very good because they had some really bad metrics previously here. So they currently have an occupancy rate here at 97%, which is quite high, I would say. Obviously 100% would be the best, but it's not realistic since some of these companies are probably doing renovations and so on. They probably have some tenants who's leaving and some new tenants coming in a few months. So, having 100% is probably not realistic, but a 97% occupancy rate is very, very high. We can also see some companies here that doesn't have any occupancy rate at all, and it could be the case that maybe they have hotels. It could be the case that they don't report this KPI at all. So there could be a number of reasons why this is, but at least we have some companies that don't report this number at all. We also have some companies here that rates pretty badly here, so at 89%. So the numbers are quite skewed. So we can see a difference here of almost like eight or 9 percentage points here from best to worst ranking. But it actually looks pretty good for the most part. I mean, obviously being here at the bottom at like 93% or something like this, obviously this is something which management probably isn't happy about, and they want to drive those numbers up to at least 95, 96, 97%, because I think going beyond 97%, obviously even looking at this list here looks to be almost impossible here. So we're probably going to have to assume that a 97% occupancy rate is probably the best that the companies can do right now. And we have to bear in mind as well that there are probably some companies now, trying to reduce their cost, trying to perhaps consolidate some warehouses, instead of having 5 warehouses, maybe they can have 4 warehouses, or some offices, some companies that decides that maybe they should shut down one of the offices and only have 3 or 4 instead of 5 or 6 or something like this. So still, despite of that, I think that the occupancy rate here looks pretty good. It is quite alarming when companies, if most of the companies would be below 90%, because then that is a good sign that many companies are bleeding cash. They're not bringing in, the rents here. But as it looks right now, the numbers are pretty good, I would say. Now for a quick summary here and a short recap, I think it's just, good to be aware once again that not all companies have reported their latest earnings, which is the Q3 earnings here. So some companies still have the 2Q figures in this video, so just bear that in mind. There were also some companies here when we looked at the dividends here, that had almost preferred shares or D shares, which are not the same as ordinary common shares. So also please do remember that we're not comparing apples to apples in this overview. It's just to get a quick snapshot on how the KPIs look like for a mass amount of companies. So if you're interested in any of these companies, you want to dig into one of these companies a little bit deeper, perhaps you can use this video just to get some inspiration on where to look for. But yeah, and I can just mention also that real estate companies right now are under quite some stress. So the share prices has, for the past 12 or 15 or 16 months or something like this, the share prices have been, quite negative or in decline for many companies. So some of the KPIs may look very good, but it could also be the case that maybe it's too soon to jump on board for some of these cases or some of these companies, because there are a lot of market stress right now, especially for financing or refinancing, because the companies here, the real estate companies, they don't want to pay the new interest rates, and they don't want to pay the difference here because the prices are quite expensive here for the bond market, especially I would say where the buyers and sellers are quite far from each other. So the expenses for those finances are showing a little bit now in the numbers, but they could be worse here for the coming quarters as more and more financing has to be done at higher levels. At the same time as some of these companies perhaps are struggling, to ask their tenants for higher rents here. So the summary here for the Swedish real estate market is that it's under quite some stress here, and it will be stressful periods here for the coming quarters as well, I would assume. All right, this was it for this video, a little bit of a different video compared to the other ones, but I hope you liked it. So please thank you for watching, and if you liked the video, please hit the like button below and subscribe for more content. Thank you very much.